Hi, this is Nick. Welcome to Quest. One of the first decisions that people face when setting up any kind of trade is should they be limited or a sole trader. So in another video I'm going to talk about the regime for limited companies, so you can take a look at that. Today I'm going to be talking about sole traders. But let me just kind of start by saying it used to be the case that there were fairly clear tax advantages to having a limited company, but over recent years those advantages have kind of been stripped away by the government. So as I speak now, which is October 2017, there are still some advantages just about, but it's a close run thing. There's not much in it anymore. As a sole trader, if you've set up some kind of trade and you haven't done anything, you haven't registered as a limited company, you haven't done anything else, then by default your status is sole trader, right? So you're sole trader. Now that doesn't mean to say you have to be on your own. You can still hire people, you can put people on the payroll, but nonetheless your tax status is a sole trader. And the tax regime for you applies as follows. Your year, unless you specify otherwise, will start and finish. It will start on the 6th of April every year and finish on the 5th of April. And the tax for that period of time has to be reported and paid the following 31st of January. So if you set up today, it's now mid-October, your first year will run from mid-October through to 5th of April, and then years after that will go from the 6th of April to the 5th of April. But nonetheless, the tax has to be reported and paid by the following 31st of January. And the temptation is to think, brilliant, I've got loads of time to pay my taxes, great. And you have got a long period of time. But if you compare, say, being a sole trader to being an employee, as an employee, the tax that the government takes off you, they take off you before you've even got it. You know, you get your pay slip and you only ever get paid the net. So you don't have the luxury of having the extra bit that's going to be the tax in your bank account that you can do something with. Whereas with sole traders, you've got, it appears, tons of time to actually sit on that cash, do what you like with it. So you know what HMRC does? They get their own back, and it's a mean trick. So the first time you come to do your self-assessment and to pay taxes on the first year of trading, you'll calculate your tax. Say you come out and you've got a tax bill of, I don't know, £4,000. You are going to pay £4,000, it's in your self-assessment, but what HMRC insist upon is that they add another 50% on top. So the first time you come to do your tax bill, there is an additional 50% added to it. So suddenly, instead of paying £4,000 in tax, it's now £6,000. And the following July, you have to pay the other 50%, so it's another £2,000. By the time you get to your second year, this starts to even itself out, because what you'll do is you do your taxes, calculate them, they'll add 50% on, but they'll also take off what you've already paid towards that year. But it does mean in the early years, especially as either in your first year or if your income is rising, be aware that you get this nasty 50% on top, and it really catches people out when you come to pay it. So the tax position is you pay income tax rather than paying corporation tax, but they're both set at a corporation tax has just come down to 19%. So the corporation tax rate is slightly less. If your earnings take you into the higher rate band, then you'll pay obviously a much higher percentage. You'll pay 40% tax instead. Your tax year starts on the 6th of April, finishes on the 5th. You've got to pay the tax 31st of Jan. But when you get there, there'll be another 50% added on, just from a miserly HMRC, so they can get their own back for the amount of time it's taken you to pay your tax bill. I hope this gives you an idea of how the tax framework works for sole traders. In a separate video, we're going to talk about limited companies. Thanks, bye.